This video will help you understand how tax loss harvesting works so you can try to reduce your tax bill. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. So as markets rise and fall, that can oftentimes be a troubling time for a lot of clients. However, for others, it can present some great opportunities. One of those opportunities is to maximize on the decrease in value in some of your securities and positions by purposefully selling out of them to generate a loss. Essentially what I'm referring to is called tax loss harvesting, which is simply defined as when you proactively sell out of a certain position to capture and recognize a loss in capital gains so you can offset gains in your portfolio that you've generated elsewhere. So in this video, we'll break down how to do just that. So let's jump in. There's some other proactive strategies you can employ when the markets are down, such as buying the dip, where you take a lump sum of cash and input it into your portfolio when security prices are relatively low compared to where you think they will be in the future. And there's other strategies like Roth converting, because if you Roth convert a smaller dollar balance that soon will rebound to a much larger balance, you pay a smaller amount in taxes. Those are sort of beyond the scope of today's video. The focus today is on tax loss harvesting, which is really only valuable for any non-retirement or non-qualified investment assets you have. So this would be things like brokerage accounts, joint investment accounts with you and a spouse, or individual investment accounts. For a lot of my tech clients out there, you'll have some type of company stock portfolio that gets created for you when you first come on board. And those are oftentimes called the TOD account. So like, for example, at Microsoft, you'd have a Fidelity TOD account, and that's where your Microsoft shares vest into. That is technically a non-qualified account. So said another way, you can't really employ tax loss harvesting in qualified or retirement accounts because the whole purpose of harvesting losses to offset gains, you don't generate losses or gains from a tax perspective in your retirement accounts, because those are all tax deferred. So what is tax loss harvesting? Well, let's define it again. It's proactively selling out of securities for a loss to offset gains that you're generating elsewhere in your portfolio. In portfolio in this instance doesn't necessarily just mean that specific investment portfolio. If you have multiple non-retirement investment portfolios, or you have some real estate in the balance sheet, whatever, all of those non-retirement investment assets I would consider as part of your total portfolio, because you can use passive losses in an investment account to offset gains that you might generate from a real estate transaction. It doesn't necessarily have to be in the confines of an investment portfolio, although that's normally how it's described. Let's walk through an example to illustrate my point. Let's say a couple years ago, you set up a taxable individual investment account so you can make trades and do all your stuff. And in this instance, a couple years ago, you bought Nvidia stock and Moderna stock. Over the past couple years, Nvidia stock's done quite well, so you might have a number of embedded gains in that position, whereas your Moderna stock hasn't performed quite as well, so you might have a number of embedded losses in that portfolio. Now, you haven't sold out of either position, so technically you haven't realized or recognized any capital gain ramifications. But let's fast forward and say Nvidia's done so well, you want to take some investment chips off the table, and you want to sell out of your Nvidia stock at the high, take those proceeds and maybe reinvest them elsewhere. However, if you were to do that, you'd generate a number of capital gains, because since the time you bought the stock to when you're looking to sell it, there's been quite a bit of growth. And for a quick note on capital gains taxes, the math is figured out very simply. Whatever you bought the position for versus whatever you sell the position for, that delta right there, that's going to be considered capital gains. Depending on how long you've held the stock, depending on your income tax bracket, depending on what state you live in, etc., those are all going to factor into how much you'll pay in taxes on that gain. And that's beyond the scope of today's video, and the good news is you don't really even need to know that math for the purposes of understanding how tax loss harvesting works. So let's go back to our example. So again, we've got Nvidia stock and Moderna stock. Nvidia's done quite well. You're looking to sell, but you unfortunately would generate a number of gains if you sold out of that stock. Let's say your Nvidia position's up 20 grand. You originally invested 10 grand, now it's worth 30 grand, and you've got 20 grand of gains. Coincidentally, you do the math on your Moderna stock and you realize you've lost 10 grand. Let's say you put in 20 grand to Moderna stock and now it's only worth 10. So you've actually got a loss over there with Moderna. If you're not so keen on paying capital gains taxes on 20 grand of capital gains in your Nvidia stock, you might choose to proactively sell out of Moderna stock. You'd lose 10 grand, you'd recognize a $10,000 capital loss, and you can use that loss to offset a portion of the gains you're otherwise generating from the Nvidia stock sale. So in this instance, you'd sell Nvidia and you'd recognize 20 grand of capital gains. Then you'd also proactively sell Moderna and you'd recognize 10 grand of capital losses. 10 grand of those losses gets to offset at least 10 grand of the capital gains. So in this instance, you only net 10 grand of capital gains by selling both positions. Ultimately, you end up paying half as much in taxes. Let's caveat real quick to something you're going to want to avoid if you look to do tax loss harvesting, and that's called generating any wash sales. The wash sale rule says that if you look to sell a stock, but you purchase a substantially identical position 30 days before that sale or 30 days after that sale, then the losses you generate will be disallowed and you won't be able to use those to offset any gains. AKA, you can't sell out of the Vanguard S&P 500 fund on Monday, generate a bunch of losses, and then buy it again on Tuesday. That'd be considered a wash sale. Now, you can buy other positions on Tuesday and get that money reinvested. The IRS simply says that they can't be substantially identical. And the whole purpose behind this is the IRS doesn't want you to generate artificial losses in your portfolio solely to save on taxes. Now, of course, we're going to talk about ways to play and waltz within those rules, but that's the whole purpose, is they don't want you to artificially generate losses. Now, of course, one easy strategy around the wash sale rules is whatever you sell out of, just wait 30 days and then get back into the position in the next month. The downside to doing that, though, is you've taken those proceeds out of the market and you're no longer investing that money, which means you have an opportunity cost of an entire month. And if the markets are moving up and down, that's oftentimes not a good strategy. You want to get back invested in the market. As far as the definition of substantially identical, that's a bit fuzzy, but needless to say, from private letter rulings that have occurred in the financial space, the general guidance is that as long as the positions are fairly different and you use things like mutual funds or index funds, you can find some crafty ways around these rules and not change the fundamental asset allocation of your investment portfolio. Said another way, if you sell out of the Vanguard S&P 500 fund, buying the Fidelity S&P 500 fund probably will be considered substantially identical and you would have a disallowed loss. That'd be considered a wash sale. Whereas if you had the Vanguard S&P 500 fund and you sell out of that on Monday, and then on Tuesday you put those proceeds into a actively traded large cap mutual fund with an emphasis on AI, those are substantially different enough that the IRS probably won't consider that a wash sale, and you probably would be allowed to capture those losses. This is not legal advice. Knowing the wash sale rules are important as we segue into actually how you would do tax loss harvesting in a real world scenario. So let's jump into that. Going back to our previous example, no advisor on the planet should recommend that you have 2 stocks in your entire portfolio and that you rely on those to sail you past the retirement Rubicon. At least no good advisor, in my opinion. In fact, most of the academic wisdom today is moving in the direction of recommending clients invest their money with a long-term mindset into super broad-based, well-diversified index funds and ETFs, as opposed to back in the day where it was the hot stocks of the week and then hiring someone to actively day trade stocks to, earn a higher than market return. This doesn't mean that one can't outperform the market by employing those strategies. You absolutely can. The problem is, on average, individual stock-oriented portfolios will severely underperform the market, and so the math just doesn't make sense to try to do that. So in keeping with this philosophy, we'd only want to tax loss harvest as long as it doesn't jeopardize the fundamental asset allocation of our portfolio. Let's look at a more realistic example of how tax loss harvesting would work, and for that we'll go to the whiteboard. Okay, so let's say after running your financial plan, you've determined the best portfolio for your non-retirement investment assets is some type of, we'll call it 20% bond and 80% stock portfolio. As we've already agreed, philosophical first principles, we probably don't want our portfolio to be made up of individual stock selection barring any unique circumstances. So let's say we've agreed that index funds are the way to go, and we're going to have 80% of our portfolio in a large cap fund, something that tracks the S&P 500. And our bond position would be in some type of, bond index fund, right? Whatever. Let's say we're tracking the index and we see the S&P 500 has suffered some severe volatility, and your holding position in here went from 100 grand down to 50 grand. Technically, at this point, you haven't lost any money because you didn't sell, right? Common trope in the investment space, unless you sell, you haven't actually lost any money. However, we might want to purposely lose money by selling out of this position and generating a $50,000 loss. We would take those proceeds and invest that into another type of large cap fund. And we talked about before, like maybe some some type of mutual fund, something with an emphasis elsewhere, basically something that's substantially inequivalent to the S&P 500 so that you don't fall victim to any sort of wash sale rules. In this case, we'd leave our bond index just as it is. In this situation, we haven't changed the philosophical undergirding of our portfolio, which is we want roughly 80% of our portfolio in stocks, and we want 20% of our portfolio in bonds. We're changing the investment selection, but we're not changing the philosophical allocation, which appears to drive the majority of success for investors. If you needed another reason to not actually have this be your portfolio, but maybe a portfolio that has more diversification, which is generally recommended for most people, let's take a look at what you actually could do with a more diversified portfolio. And the bottom line is it just provides more opportunities. So let's take a look at that portfolio again, and let's say we've determined again 20% should be in bonds of some kind, right? And 80% should be in stocks. However, in this situation, instead of having all 80% in one fund, let's say we further subdivide and say we're going to have 50% of the portfolio in some type of large cap fund. S&P is a pretty popular choice. And maybe we have, I don't know, another 20% in, we'll call it mid cap, some type of mid cap fund, right? And then we have 10% in some type of small cap, right? Is this a recommendation? Absolutely not. But just as an example, the more diversification you have, the more opportunities you have for tax loss harvesting. So for example, let's say the large cap space is flat, bonds are maybe up, and small cap is down, right? And we'll just say mid cap's flat as well. Well, in this situation, in the previous portfolio, if large cap is flat and bonds are, flat or up, there's not really any tax loss harvesting opportunities. Whereas the more diversified we are, we have more markets, if you will, to capitalize on volatility. So maybe in this situation, small cap is down, and so we're going to execute some tax loss harvesting from there. We'll go from one small cap orientation to another small cap orientation or allocation. We change the fund selection. It's substantially different enough to avoid any wash sale disallowing. And then 31 days from that swap, we go back to the original small cap fund, and our portfolio goes back to homeostasis. So the more diversification you have, the more opportunities you have to take advantage of tax loss harvesting. And generally, this is also a good recommendation to have a more well-diversified portfolio. So as we wrap up, one question might be, when's the best time to do tax loss harvesting? Well, the best time to do tax loss harvesting is when you've suffered a number of losses that you want to take advantage of. And that can happen throughout the year. Most people usually wait until December timeframe because it's the end of the tax year. And any losses that you want to capture for the year, you've got until the end of the month to figure it out. The downside about trying to time when to do tax loss harvesting throughout the year is that you kind of have to time the market, meaning you have to figure out, are we at the deepest dip of this dip, which is kind of hard to predict. And unfortunately, if you time it wrong, you have to do some tax loss harvesting all over again. So let's say in October, you do some tax loss harvesting because some positions are down and you've generated gains elsewhere. And then in November, the market takes another dip. Well, now you have to make sure you're playing within those wash sale rules, and maybe that means finding a third portfolio that's not substantially identical, but still doesn't change the fundamental allocation of your portfolio. It's a little bit more complicated at that point, and then you have to wait another 30 days before you can trade back to the original security you started with before October, and all that can be fairly complicated, so oftentimes people just wait till December. In fact, for those of you who are investing in 2018, you saw this very thing play out, whereby in 2018, Q4, so October through December of 2018, we saw a significant number of people start tax loss harvesting around November timeframe. And then we saw the stock market take quite a bit of a decline. Maybe it was due to the tax loss harvesting or maybe something else fundamental. But ultimately, the tax loss harvesting didn't help. And when you're a trader and you see a number of positions being sold, you might follow the bandwagon and start selling your positions too. And so the market takes a little bit of a dip. Well, that market dip now makes tax loss harvesting again fairly attractive, so people further tax loss harvested, and then coincidentally in January the next year, all that stopped and we saw the market rebound in the early parts of 2019. I'll link below to the S&P 500's performance over that time frame, and you can see exactly what I'm talking about. So calls to action wise, as we get close to the end of the year, I'd highly recommend looking at your portfolio to determine if there's any positions that are at a loss that you might want to tax loss harvest out of to offset gains you've generated elsewhere in your portfolio. For the most part, 2023 has been a good year for the market, So you'll probably have some gains generated in your portfolio if you've made any sort of trades this year. And if that's the case, then maybe harvesting some losses elsewhere could save you on taxes. In addition, just one more reminder, I would make sure whatever changes you make to your portfolio don't fundamentally change the asset allocation. That's the biggest driver of success. Tax loss harvesting is an added cool spice on the portfolio. You really don't want your portfolio to chase around tax savings. That's a really easy way to blow yourself up. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. Have an awesome rest of your week. We'll talk to you later. Bye.